Traders at UBA said they expect the bullish sentiment in the Treasury bills market to continue next week, owing to high liquidity at the market. Chuka Nwachukwu, head of ALM and Balance Sheet Management at UBA, joins me now for more market updates. Chuka, thank you so much. It's always a pleasure to have you. Let's start with you bringing us up to speed with today's trading action. I understand that there's quite a significant amount of liquidity at the market.
Yeah, today market opened yesterday with about 664 billion. That's huge liquidity, like you mentioned in the market. Today has been generally quiet due to normal Friday trading activity, and then of course the CRL debit. But on Wednesday we had an NTB auction where about 217 billion was on offer, and then twice as much as that was sold. So we saw a drop in yield, like we predicted, by almost 254 basis points from 4.78 to 2.24. And the market has actually followed that pattern. You know, those who lost at the auction have come into the secondary market to see how they can cover the bid that they lost.
Now, we know that increased demand for short-term instruments, the market has pushed rates from a high of 11% in 2022 down to what we're seeing now. But what are the forecasts in terms of how long this trend could, possibly potentially last, and what could be the catalyst that could, lead to an uptrend?
Okay, well, the drop in yield you're talking about is only on the T-bill side. That is because on the bond side, we've seen an increase in yield. We've seen yield increase by, like the last auction, we've seen it increase by almost 200 or 220 basis points. So for what we intend to see, on the bond side, we continue to see, we see upward movement in yield, considering the fact that the government is looking to borrow heavily, and then they've actually mentioned that, specifically mentioned that they will borrow heavily from the bond market. So that will make that yield to be attractive. Now,
the general expectations for investors is that inflation is going to increase further going forward. It's going to get worse before it gets better. I guess I can put it that way. Is this going to be the year of the patient investor? I mean, they've been in this, been in the trenches, as it were, with low. I mean, we did see that spike last year for treasuries, but we're back down with low rates. So, is this going to be the year where investors just have to be patient, especially on the real return side of things, looking at where inflation is right now?
Yeah, the investors need to be very patient. Two things. One, the election. Obviously, no investor will want to dabble into any market that is filled with uncertainty. So the election has brought in a little bit of uncertainty, and I believe and I hope and pray that the election will come out well, which I believe it will. So anybody looking to invest will definitely wait till after the election. However, we have seen this pattern last year, the year before. We see there's a period where the youth will elevate as high as 15%, and then there are periods when it went as low as 3%. So this year will not be any different, but though this year will also be special, especially with the election. So I see this pattern play out throughout the rest of the year.
Well, what then is the fate of corporates who are looking to raise cash, at the corporate bond market, to fund, just basically raising cash like we saw last year, commercial papers and all of that? What is to become of them this year? Are they also going to wait? I mean, looking at the benchmark, of course, of the sovereign against what they have to borrow, it's a little higher. What are your thoughts on that?
Yeah, I think the corporates will have to meet and match the government borrowing on the physical market, especially on the bond side. I mean, because government is looking to borrow heavily, the yield will continue to be attractive, and so we see elevation in the yield. And so the corporate will need to match that in order to make headway in the bond market, especially.